Hello, my fellow investors, and welcome back to the second company that we're going to do during the live stream. Coca-Cola. They just had earnings today, Monday, before market open, and they actually did very good. But for some reason, throughout the day, they have just completely fallen. Like, not a lot, but they are essentially flat, pretty much. So let's take a look at these earnings and then see if the current share price is looking like a buy. So with that said, let's get started. Now, coming over here to the earnings release, if I could actually find it, this is all messed up for me. We see that their normalized estimate was 68 cents, it beat by 3 cents. EPS gap, 72 cents, beat by 7 cents. Revenue, almost $11 billion. Could you believe, Mike, that this company, as big as it is still beating revenue by $175.06 million?
That's insane.
That's crazy. And still beating on everything else. That's not too shabby.
No, it just shows how strong of a company.
Right. So I also love it how, actually, we can even take a look at what it was. Actually, wait a minute. Why is this saying 424 yet this is saying 73 cents? I'm very confused. I'm guessing they updated this for the next one, but I don't know. I don't know. Well, whatever. This is the actual earnings, guys. And if we come over here to the news, we can see that Coca-Cola non-GAAP EPS of 68 cents beat by 3 cents. Revenue of $11 billion beats by $220 million. Wait, is this updated? I don't know if this is updated or not.
Remember, they could be pulling from different sources for the
I don't think
estimates.
so. I don't think so. I just don't think that this is fully updated. Because again, usually when earnings come out that same day, either Seeking Alpha has this all messed up, or it just, or it's just not updated at all.
On my end, it's saying they beat by 161 million.
161 million. Okay.
Which is, it's up. I think, remember, the 220, it depends what they're citing as.
Right, what the estimates were to begin with. Because every estimate's different. So, okay. So, with that said, guys, now let's head over into the earnings report when it comes to Coca-Cola. And again, I will have this linked in the description below for the video. And in the live stream, I will have all of them linked in the description below as well. And of course, remember, this is not financial advice. Every investment is the present value of all future cash flow. So, let's get started with this news release. We got global unit case grew. Global unit case grew 3%. That's crazy. That's insane. What's even more crazy, Mike, take a look at this. You want to read this over here? Read that for me.
Revenues grew 5%. Organic revenues grew 12%. Wow.
Organic revenue, though. What?
That's stuff they didn't even have to do to get revenue.
Organic freaking revenue. That's insane. Operating income declined by 1%. Honestly, who cares at that point? Comparable currency neutral operating income grew 15%. Okay, that's just because of the whole currency situation with the dollar going up and down recently. Operating margin was 30.7% versus 32.5% in the prior year. Comparable operating margin of non-GAAP was 31.8% versus 31.4% in the prior year. EPS grew 12% to 72 cents. Comparable EPS of non-GAAP grew 5%, 68 cents. Wow. That's just wow. Is Coca-Cola the new Apple? And I mean that kind of tongue in cheek because Coca-Cola is not new or in the tech sector. But yeah, that's very, very interesting. All right, we got over here a statement from the CEO. We got the Coca-Cola company today reported first quarter 2023 results demonstrating resilience in the marketplace despite an operating environment that remains dynamic. Quote, "We are encouraged by our first quarter 2023 results," said James Quincy, chairman and CEO of the Coca-Cola company. "Our system alignment is stronger than ever, and our networked organization is allowing us to adapt as needed. We continued to invest for the long term, strengthening our capabilities to drive sustainable value for our stakeholders. We have the right portfolio, the right strategy, and the right execution to deliver on the marketplace. We are confident in our ability to deliver in our 2023 objectives." So not only are they saying that we had a great quarter, but they're thinking that they're going to be doing very good even like moving forward, which is really, really good. That's just really good guidance overall, right?
And also that they're investing. It's not like You're just trying to shelter capital. You're basically saying, hey, we got a strong balance sheet and we have money to spare.
Right, right. So let's, what I want to know though, let's see if we can find, okay, so I heard about this. So I pretty much knew about a little bit of these earnings just throughout the day because, like, you know, this came out like at like 7 a.m. But it's interesting because, well, I believe that the majority of the growth, I think, occurred in Latin well. So look at this. Let me just not make any assumptions here. So this is the percent change from the revenues and volume. All right. Mm-hmm. Europe, Middle East, Africa. Organic revenues, 23. Latin America, 19. North America, 9. Asia Pacific, 3. Global Ventures, what is that, 5. And bottling investments, 11. So you could see that majority of the change when it came to their organic revenues was in Europe, Middle East, and Africa, and Latin America. And what did we just read up here? The fact that organic revenues is up 12%. So if it's up 12%, and majority of this change came from Latin America and Europe, Middle East, and Africa, this is telling me that in, you know, I could say this because, you know, I'm from one of these countries. Third world countries, I know Europe is not a third world country, but like Latin America, some countries in Latin America are third world countries. In Africa, I mean, of course. So it's surprising that even in, you know, these kinds of countries, Coca-Cola is still like a main stake. That's crazy. Right?
Shows the strength of their business model.
Shows the strength of their moat. Warren Buffett is always talking about moat.
Moat?
Yeah, moat. You know what that means or no?
Nope.
So, moat, really? You don't know what moat means? So, moat, what a technical analysis answer. Moat is essentially the market hold that a company has over the market. You get me?
Okay.
So, for example, if I were to tell you, if I were to just tell you chips, what's the first company that comes to your head?
NVIDIA.
There you go. Why? Because they have such a big moat when it comes to the marketplace. Yeah. Right? Right? That's essentially what that means. When I tell you phones, what's the first company that comes to your head? No, don't say Samsung. I know you have a Samsung.
Say Samsung.
And they're gonna say Samsung because okay. Apple, right?
Well, yeah.
Yeah. Yeah. When it comes to software, what's the best company? What company do you think of? Microsoft, right? The reason why you think of that is because they have such a big moat. And when it comes to sodas, what's the first thing you say? Coke, right? You don't say a Pepsi. You just say Coke. So that's essentially why, you know, they're having such great growth, because even in countries that aren't even developed yet, they have massive reach. And if I show anybody in the world a Coca-Cola can and just hide the name of it, people know it's a Coca-Cola can.
Yeah.
So, yeah. That's pretty much when it comes to everything that I want to actually do. I kind of want to read this over here. When it comes to the Europe, Middle East, and Africa, we got unit case volume declined 3%. A strong growth in Western Europe, Pakistan, and South Africa was more than offset by the suspension business in Russia. That's why they went down, is because of the whole Russia situation. Okay, that makes sense. Price/mix grew 22%, driven by pricing actions across the operating units, along with the inflationary pricing in Turkey. Is that really how you spell Turkey? Wow. Concentrate sales were 5 points ahead of unit case volumes, largely due to timing of concentrate shipments. Operating income grew 13%. This is just, by the way, in Europe, Middle East, and Africa. Operating income grew 13%, which included items impacting comparability and a 16-point currency headwind. Comparable currency neutral operating income grew 28%, as strong organic revenue growth across all operating units was partially offset by an increase in marketing investments and higher operating costs versus the prior year. Wow. That's a mouthful. And pretty much, here's Latin America. Kind of the same thing, honestly. So, growth was led by Mexico and Brazil, of all countries. Growth was led by Mexico and Brazil. All right.
Yeah, they're both an expanding economy right now.
I believe it. I believe it, especially Mexico.
You'd be shocked how
especially Mexico.
big Brazil's economy is. We have a plant down there where for my work, and that market is growing rapidly.
Yeah, man. I do not. To me, the developing world. A lot of people could say China. A lot of people could say India. To me, it's like Mexico, right? Brazil,
A lot of Latin America,
Argentina, Chile, right?
Yep.
That to me is the emerging markets. But that pretty much does it for these earnings report, guys. Now let's head over into the discounted free cash flow. So we're gonna be using this because, well, we can. This is not a bank. So we got the ticker symbol for KO, Mike. It's not the company that you were thinking of. Yeah. So make sure you put it right in your trading.
Yeah, I got it.
All right, good. We got the market cap of $276.7 billion, a P of 29.15 with a current share price of $63.95. If we take a look at this price, guys, on the 1 year, they're barely down. Well, they're not barely down. They're down 3.02%. But what I mean is that this isn't as down as other companies are. Year to date, we can see that they're up almost 1.6%. 52-week range is $52.02 to $67.20. Now, the one thing I do want to point out with this price range is that if we take a look at the 5-year, if we take a look at COVID, look at this. $59, right? $60 right at the peak of COVID, February 21st, 2020. And the low of COVID was, let's see if I can get my cursor over it. If I can. What was it, like $40, $39 or so? There you go. $39.45. So this company hasn't really moved much at all since COVID. I get that, from 60 to 39 is a big drop, but overall, a lot of companies have fallen and have not recovered yet. This one, not only did it recover, but we are up since the pandemic, well, since right before the pandemic. So very, very interesting to say the least. Now, on the intraday, here's what's interesting about this. Guys, it has fallen down 0.16%, even though they had amazing earnings. And when the earnings came out, they actually rose a pretty big amount. Let's actually look at this on the 1 day. You can see that, well, actually, never mind, I'm mistaken. They fell pretty much all throughout the day. Okay, I guess. I only took a look at this pre-market. I didn't take a look at this after the rest of the day. But never mind, I guess they did just continue to fall prior from the initial just jump, like from like the first 30 minutes or something like that. So
basically looks like profit taking. It had a big
does.
run up.
It honestly does. Those earnings do not support such a massive drop in the company. So yeah, it is what it is. Coming back down into the discounted free cash flow, we got that they do pay out a dividend of $1.84. And if we take a look at this dividend, we got, guys, a yield of 2.87%, a payout ratio of 71%, which is a little bit high for my liking. 5-year CAGR, I'm only at 3.5, so it's not that big. But look at this. 60 consecutive years of dividend payment. Basically, they have grown this dividend and paid a dividend for the past 60 years nonstop. That's pretty good. In fact, anything above 50, Mike, I know you probably don't know this, but anything above 50 years is considered a dividend king. You heard?
Yes, I heard.
Okay, great. It's pretty much considered a dividend king. So 60 years, only a few companies out there actually have, 50 plus years. Ex-dividend date passed as of March 16th. Payout date was the 3rd of April, and they pay their dividends quarterly. So, coming now into this, after this dividend is paid out, based off the current shares outstanding, they are still left with, they pay out almost $8 billion in dividends every single year based off the current shares outstanding. And after this is paid, this is a little bit concerning though, right here. This is a little bit concerning, huh? Do I have that, it's $1.84, right? Yeah, $1.84 for the annual dividends. That's interesting. Huh. Well, after this, almost $8 billion is paid, guys. In their 5-year average free cash flow, they're left with $827.5 million, which is really cutting it. But as of the last year's free cash flow, they're left with $1.57 billion. These payout ratios are Well, 83.53% for the last year's free cash flow and 90.6 for the 5-year average. That's bad. Anything above 100 means that they're taking on debt. And sure, right now they're not at 100, but this is not leaving a lot of room for capital expenditures, buying back shares, paying down debt, etc., etc., etc. So that's not something that I want to see. What is your opinion about this, Mike?
Well, but also, are you taking into account that like the severe, let's say, not downturn, but like the state the economy is in, would that be something that you would expect that kind of companies are going to look to other sources of income as certain income sources and streams kind of dry up?
I guess, and I also have to take into account the fact that this is Coca-Cola. Like, this company is massive. And the bigger a company is, the harder it is for them to grow. So, yeah. That's just...
And also, like, the way the stock trades, in my opinion, just looking at the chart, you're not paying for necessarily growth. You're paying for the steady
you're definitely,
appreciation
yes, 100%.
of the dividend.
Yeah, not even that. You're mainly just paying for, like, steady growth overall. So, yeah. Let's come now into the fundamentals. Let's take a look at this. We got the net income 5 years ago of $6.4 billion to 1 year ago of $9.5 billion, increase of 48%. You can see the dip here during COVID, but aside from that, really isn't that many major dips. They did go down from 2 to 1 year ago by around what, $200 million, $200 million or so, but nothing too major in my personal opinion. This one's perfectly understandable. So what would you give this as a grade?
95.
95. Here's my thing with the 95. 6.4 to almost $9 billion. That's a big jump. Because like if you take a look at ignore the 3 year ago value, that's an outlier, right? A one-time thing. Look at this difference from 4 to 2 years ago. That's what, $1 billion difference, less than $1 billion difference, and yet from 5 to 4 years ago, this thing went up. You know, like a significant amount. What, $3 billion, more than $3 billion? No, sorry, $3 billion or so. So I am not comfortable with a 95. Personally,
What
with
would
me,
you say?
I would give it like a 75. Well, I would give it like
80?
an 80. Yeah, I would give it like an 80. I would give it like an 80. Also a little bit concerning here, the fact that 2 to 1 year ago, it did go down, but yeah, it is what it is. Looking now at the free cash flow, cash from operations, less your capital expenditures. Now we have seen that they are barely able to pay out this dividend with this free cash flow, which by the way, free cash flow can be used to pay out the dividend, buy back shares, pay down debt, make acquisitions, and just overall grow the company. So, very, very important. We got here 5 years ago of $6.1 billion to 1 year ago of $9.5 billion, increase of 57% with an average of $8.8 billion. You can see here that, well, the 3 year ago, there wasn't really much of an outlier. The outlier actually occurred 2 years ago, going from $8.7 billion to $11.3 billion, and then it came back down roughly to the mean, right? Roughly to where the 4.3 and I guess a little bit of the 5 year ago value is, right? So what would you give this as a grade?
About 87.
87? All right. 87%. Yeah, I would have given it like a 90, honestly. I would have given it like a 90. Looking now at the revenue. This one's actually isn't looking too bad. We got 5 years ago of $34.3 billion to 1 year ago of $43 billion, increase of 25.4%. The dip here 3 years ago, we can pretty much ignore it. Now, you can see here that actually, never mind. 4 years ago to 2 years ago, it was an increase. It was a slight increase. You can see that. Not by much,
And
but it
it's
was.
slowly trending up.
Right, and if you take a look at just the overall graph, it's still consistently going up. What would you give this as a grade? No major
90.
outliers either. I would go. Actually, yeah, no, I would give this a 100%, honestly. That's just me.
I don't.
Cause think about it. The reason why it occurred 3 years ago is because of COVID. Like
Yeah,
it's such an
statistical
outlier,
anomaly.
right? It's such an outlier. I just don't see that happening again. And maybe I would say like 90 or even 95 if 2 year ago value was lower than 4 year ago, but it's higher. And not only that, we just saw in their earnings that, you know, their revenue, their organic is up. Their organic revenue is up a whopping 12%. That's huge. That's absolutely huge. So I'm more comfortable with 100% on this one, honestly.
I'm good with that.
All right, good. Total assets minus total liabilities. We can see a very good increase overall. No major downtrends. A little bit of a spike from 3 to 2 years ago, but that could be perfectly explainable. Again, low interest rates. You had COVID. A lot of people were buying more soda. And you saw more of that the prior year. Sorry, not the prior year. The year following COVID than the year of COVID. So, that kind of makes sense, I guess you could say. Overall, though, very, very consistent. Average total assets, it is almost $91 billion. Average liabilities, it is $67 billion. Doing this difference, we get almost $23.8 billion. What would you give this as a grade?
95.
95? 95. All right. 95. And cash flow minus the liabilities. What am I looking at? Well, we take the cash flow, we subtract the liabilities, or I guess add the liabilities since liabilities are technically negative. You can see, very consistent. Now, their lowest point was actually 2 years ago, not 5 years ago. But you could see that from 5 to 4, it was an increase. And then from 2 to 1, it was another increase.
But it's staying steady, that's the thing.
It's staying very steady. If anything is slightly going up, I don't know how comfortable I am of saying that, but you can see that even as of 1 year ago, it's still lower than the average at negative $57.58 billion. So what would you give this as a grade? It's steady. It's steady.
I'm gonna say 80, just because
That's
you don't
giving
necessarily want to see
negative. Yeah, but 80. So here's the thing. For me, an 80% would be like, if this line of best fit was slightly, or like if this trend line was like increasing it, like getting closer and closer to zero. Right. So for me, I would personally give this as like a 55%. Because
meet in the middle at 65.
60.
Okay.
60. All right. Yeah. 60. I just don't like it. The fact that it's consistently the same. You get me? Anything above 70 would be like if this thing is like increasing into the positive, but it's just not good. So when it comes to the shares outstanding, this one caught me by surprise because, well, we could see 4.27 billion shares outstanding 5 years ago to today of 4.33 billion shares outstanding. That is an increase on the 5 year, but it's an increase of only 1.41%. And on top of that, very consistently increasing. You can see that trend line is like touching the troughs of like, or not the troughs, the crest of every single one of these graphs. So interesting. And then from the previous year to the current year, that is another increase of not even 0.1%. So what would you give this as a grade?
Since it's not decreasing and you're slightly increasing, maybe like a 65.
65. Yeah. I would give it a 65. I'm actually curious.
Improving.
I'm actually curious. Hang on a minute. I want to see if, I don't know if they announced any buybacks or not. I just want to see if there's like any news on this really quick. I don't believe so. Let me go. Hang on a minute. Let me check out if I can find any of like repurchase. Nope, there's nothing there. Shares outstanding. I mean, I got this, but okay, that doesn't really tell us much. Also, I forgot to go over their consolidated statements, but I mean, we pretty much just saw that they are increasing it overall. So yeah, it is what it is. All right, so we're gonna keep it at 65%. And lastly, when it comes to the cash equivalents, they currently hold, what is that, $9.52 billion with an average of $8.5 billion. Now, overall grades, we gave this thing an 80% for the net income, free cash flow 87%, revenue 100%, assets minus liabilities 95%, cash flow minus liabilities 60%, shares outstanding of 65%, overall grade of 83. What do you think of that overall grade? I think it's fitting.
I think it's pretty strong, especially seeing the stocks trend.
I think it's fitting though. What do you think?
I agree.
You agree? Yeah. I personally think it's fitting. It's
You have some bad, but you also have some good.
Yeah, and it's a major company as well, so I don't really see it as like a, it's like a terrible thing in my personal opinion. 83% still very, very respectable overall. And now to figure out if at the current share price, this is a buy. Are you ready for this, Mike?
All right.
Are you ready for this? Are you ready to make some assumptions? So we got the current price of $63.95. Revenue growth assumptions, projected share buyback, and of course the required rate of return 10%. Just this alone, we can see that this thing's at $22.58, not adjusting for debt. Then adjusting for debt, $17.71. So yeah, it needs to fall. just for this alone, it needs to fall. Now let's put in some of these numbers, okay? We got over here the growth. We can see that the forward is estimated at the revenue is expected to grow at 7% roughly. Now. Now that you know that this forward, but also take into account the fact that their organic growth also grew 12%. So tell me some numbers for the low, medium, and high assumption for the revenue.
The low 5%,
okay.
Median, we're going to do 7, and then high 10.
10, all right. So pretty much just going under it. All right. I actually kind of like that. And now for the projected share buyback.
-2, 0, and 2.
-2, 0, and 2. Okay.
Yep.
Okay. I like those numbers. 0. And then we got 2. All right. Well, unfortunately, target share price are between $26.41 to $32.56. And then adjusting for debt, $21.62 to $27.58. With a margin of safety of 5, 10, 50%, this is $18.38 to $26.20. Now, to anybody saying, oh my God, that needs to fall by half. Yeah, their PE is 30. Their PE is 30 as well. So it's like, I don't know what else to tell you. You know, every investment is the present value of all future cash flow. The fact of the matter is that their cash flow just isn't growing enough for me to justify a $64 price. It just isn't. It just isn't. Now, if we take a look back at this 52-week range, though, at $54, it still would have been expensive. But then again, the numbers may have been different back then. So it is what it is. In fact, I want to take a look at this. Well, actually, on the 1 year, we're essentially just going to get 54. But yeah, overall, it's still fairly expensive for my taste. Obviously, this is just based off of these numbers, right? Off of the numbers that you chose, Mike. But you guys put in, I don't know, let's just say something crazy. Let's just say that they grow at like 15% and that they buy back, let's just say 8% of the shares back. Well, that's $40. That's $40.75. Not adjusting for debt, and $35.46 adjusting for debt. So a lot closer, you know. That's just, it really just depends up to you. So once again, all of these calculators guide can be found linked in the description below. And please do not take this as gospel because it's not. Every investment is the present value of all future cash flow. And you know, you guys should make your own decisions. This is why all of this is for free on my end. So the best way that you guys can help us is, of course, by liking, subscribing, commenting, and of course, sharing. Now, with that said, let's jump over into how much in dividends you would get. It's not going to be a lot, mainly because, well, I mean, we just saw it's expensive, but also the yield's really, really tiny. Putting in $5,725, this nets us $164.73 in annual dividends. Could be better, in my personal opinion. Could be a lot better. So, it is what it is. So, with that said, I guess now we're going to move over into the technical analysis side. All right, Mike?
All right, so basically, you had a big, massive trend on the stock. And if we zoom out for a second, I do notice a pattern on the daily. The pattern to me is an inverted head and shoulders, which usually a head and shoulders is a bearish pattern, but when it's inverted, it's bullish. Now, some of the problems with that pattern. You're right at the neckline, and on earnings, you basically just pierced up, and then you came right back down. We can see that here, where your neckline is basically where the previous bases were formed. So, you know, you got to swing out to about the $74, $75 range, which you were piercing up above that range today on open. However, because you came down, there's some good and bad intonations with it. You are forming, I'll start with the good. You are forming a strong uptrend. You filled the gap.
Can you zoom in on that, please?
Sure. So you filled the gap that you formed here because you opened at the previous price. You filled all the way down to the previous close wick down below the previous day and then bought it back up. However, you did make technically a lower low on the daily, which is bearish. Now, on the daily, this is where it kind of you start exhausting, or possibly the theory of exhausting is your MACD is really trying to pinch together and your RSI is oversold. Correction, overbought. So those two combined, you hit a reversal zone, you're in a price action zone, you definitely have room to go to the downside, especially if your short-term uptrend is basically broken. So if you draw from the wicks that were previously formed, you can clearly see that it doesn't want to cooperate. You have an uptrend that you basically need to hold, and if you don't hold this uptrend, which is going back to your previous push up, then naturally you're gonna want to come back down to lower prices. Today you bounced off of it, but you need to continue higher, and you need to continue higher right now. Especially if you look at the weekly, you have a lot of room on the MACD to keep going. They're separated pretty much far from another, and stocks can stay overbought for a long period of time. That's not to say that it just blindly go in and buy. You need to see price action show support. Basically, we filled the gap, bounced off the trend line, we need to go higher. If Coca-Cola goes sideways, you're going to break this trend, and your first support is probably going to be this consolidation node here, sitting around the $62.58 price. If you break that low, then you're probably coming back down into the 60s or $58 region. That's where I would be looking for the consolidation period. Especially if I draw a fib real quick here, the 50%, which usually companies retrace about 50%, is the $61.9 region. So another, right below this distribution area previously that I just mentioned, right here, you definitely have an area that basically you're gonna want to possibly keep an eye on. Right now, would I be buying Coca-Cola based on the calculator plus everything I'm seeing here? Not really, just because it is expensive right up here. You're overbought. MACD has the potential to curl down. So I'd be looking for that pullback and maybe possibly dollar cost averaging down to a reasonable price target, and or looking at different strategies to take advantage of that. But that's just my whole quick summation about it, especially on the monthly. If we just look, you have the potential to curl up, but you're still having cross. So definitely could see higher price exploration if you get that push up, but it's really going to come up to the bulls of the company to push you higher. If you don't get it, you're looking at more downside, especially just looking at the broader market. I see more downside potential versus upside potential, but anything with proper risk management can be managed and therefore make a profit or just take out a small loss. So that's all I got.
All right, great. And I think that this is where we're pretty much just going to end it for the YouTube video in regards to the company Coca-Cola. So guys, if you like, comment, subscribe here on YouTube. You guys can follow us on the YouTube sites. Link is in the description below. So with that said, peace out, and we'll see you all next time.